Welcome back to Out of the Rough. My name's Fred Arnold, and I'm here with Dennis DeYoung. Again, Dennis DeYoung is a certified financial planner and LA Business Journal's top wealth management manager of the year. Yes, got that right. Want to talk about stocks, bonds, investments, if you will, when you're trying to create wealth, when you're trying to get out of the rough and into success. And there's a phrase I've heard before, the lost decade. Tell me about that. It lost my mind there for a minute.
The last decade. That's actually refers to the period of time that the last 10 years ending December 31st, 2009, where the S&P 500, which is an unmanaged index of the top 500 companies in the country, actually had a zero rate of return. It wasn't negative, it wasn't positive, it was about flat. It's never really happened in the history of our country where for 10 years, people who invest in the stock market actually ended up with a zero return. And by the time you factor in, of course, taxes and inflation, you've actually obviously lost money. So that's what we refer to the lost decade. It's a unique phenomenon. It's unfortunate. We had two market crashes. We had the internet bubble burst in 2000, 2001. And then, of course, we had the Great Recession and the financial meltdown in the end of 2008 and the first quarter of 2009. But between those two events within the same decade pretty much wiped out all the other gains we had during the rest of the years. And I look at that and I say, that's horrible. You know, I can tell you that I don't have a crystal ball going forward, but I really do think that for the next 10 years, we're not going to have a lost decade.
Well, I do have a belief in one thing, and follow me for a minute. I believe that U.S. companies in particular, a lot of them haven't been given money, bailout at all, and they've had to cut their expenses. And I think U.S. companies, the American spirit, they are the most efficient, lean companies that they could possibly be, because there's no one bailing them out, and they have to make their balance sheets be correct. They can't print money. They can't tax people. They have to be competitive. So I'm a firm believer that I think the stock market, in the long term, U.S. companies are going to do great because of that competitive spirit and because they have had to right-size their businesses.
I think what you're saying is absolutely true. You can see that right now. We're seeing earnings announcements coming down from companies that are announcing better and better and stronger balance sheets and better revenues and less expenses. Companies have learned how to do well with less. They've had to, unfortunately, lay off millions of people throughout the country, and they're running their operations with less people. But they have become more efficient. The people that are there, the people that are left and have their jobs, are more efficient and more productive. And technology improvements are also coming along too. So you're seeing companies right now that are announcing good earnings without having to bring back as many employees as they had before. So because of certain things down the road, they will hire more people. I see unemployment, the numbers coming down. I think they've capped out where they are. Eventually the economy will recover. The recessions don't last forever. And certainly these companies are going to be able to start taking advantage of that and announcing better and better earnings. And the stocks, we say that the earnings are a slave to the stock prices. As the earnings come back, the stock prices will rise.
And I just think the American company had to right size. I love that word, because the American public, the households had to right size, and so they've had to right size. Let's talk about some of the basics on investing, because you talk about you can invest in a stock, which is investing in one particular company.
Yep.
What other investments are there out there to put your money into?
Investing in a stock, a single stock, I say it's kind of like picking a horse at a horse race. You're putting your money on one horse, and that horse may do well, it may win. If you invest in a mutual fund, which is basically a big pie of maybe 200 or 300 different stocks in a portfolio, you're sort of betting on the whole field. And that's a less riskier way of basically investing in the stock market, because if one company blows up or falls apart or has a bad earnings season or whatever, it's one out of 200 or 300 different stocks. And so it won't bring down the entire mutual fund. And on a mutual fund, you have a professional money manager or managers, many of them are run by committees, who are basically doing the research and analyzing the companies and picking the stocks.
And investing. Right.
And investing on your behalf. So many people nowadays, either through 401k, the monies are in essence invested by mutual funds.
But the key is diversification. And I understand there's as many, and I might be wrong on this, but there's many mutual funds as there are stocks to pick from in the Dow Jones Industrial Average.
Maybe if you include exchange-traded funds, which are like mutual funds in many respects, there are more mutual funds than there are individual stocks.
Now, if you bought a mutual fund, you could buy it in a certain sector, like you could buy it in aerospace, or you could buy mutual funds that are tied to the mortgage industry, aerospace, housing, different sectors of the economy, correct?
Right. And those are a little riskier because they're investing in one specific sector. Gold is a good example of that. They only invest in gold mining stocks. When gold is going great, they do well. But when gold goes down, they do horrible. They do horrible. So basically, the bottom line is when it comes to investing in a specific sector, you have to understand you're probably going to have a little bit more volatility, depending, of course, on what stocks comprise that particular sector. But you will have more volatility than you would on say a broad-based index mutual fund or exchange-traded fund that maybe invest in the NASDAQ, which is another index, or the S&P 500 or the Dow 30. So basically, sector funds are good places, but you have to understand there's more risk involved with those.
Dennis, we touched upon on stocks and bonds, mutual funds a little bit. I want to talk about risk, overall risk, and minimizing risk. You know, you can do it through diversification of mutual funds. But let's talk about risk.
You know, risk, when it comes to risk, you cannot avoid risk in any kind of investment. Every investment has some degree of risk. Even CDs and bank investments have risk. Treasuries are very low interest rate these days. They are considered to be risk-proof, but if you factor in inflation and taxes, they're risky. Everything has some degree of risk to it, but obviously you get what you pay for. If you're willing to take more risk, if you're willing to look at maybe international stocks or maybe investing overseas, investing in sectors, you may over the long term get a higher rate of return. And that's what it really comes down to risk. If you focus on short-term investments such as bonds and treasury bills, you'll get a guaranteed rate of return. You'll have a specific return, but and less risk, but then also less return. And so when we look at risk, we try to match the amount of risk to the client, and we try to tailor the risk tolerance of that particular person with their investment. And so that's the difficult thing of being a certified financial planner, is trying to help tailor an investment that is in line with somebody's risk tolerance level. And so for young people, for college funds, for retirement accounts, these people it's appropriate. They're looking at 10, 15, 20-year investment horizons. It's appropriate for them to consider risky investments for a small portion of their assets. But if you're getting near retirement or retired, then certainly slowly, gradually removing some of the higher risk investments and focusing on moderate risk or balanced investments makes a lot of sense.
Yeah, there's so much we could talk about, and I know there's going to be a lot of questions that people have. How can the listeners and those watching the show on the internet and through SCV TV, how can they get a hold of you?
Well, my office is in Northridge. It's right here on Reseda Boulevard. But the best way is just to call. You know, I prefer a phone call. I do have email, of course, and everything. But my phone number is area code 818-280-0280. And I'm with a company called Financial West Group on Reseda Boulevard, 9401 Reseda in Northridge.
Dennis, thank you for that very, very valuable information. Really appreciate you coming in.
Thank you, Fred. Thank you for inviting me. I had a great time with you and your audience.
Absolutely, absolutely. Well, I hope you enjoyed this edition of Out of the Rough. I'm Fred Arnold. If you'd like to view this show online, log in to scvtv.com or fredarnold.com. If you have questions you'd like to send to me, send them to fred@fredarnold.com. Until our next conversation, make it a healthy and prosperous day, and I hope this information helps get you out of the rough.